So what I focus in on is the data that we're going to get today and tomorrow. So the data we're seeing right now is continued jobless claims, initial jobless claims, non-farm payroll productivity, and the trade gap. So what I want to explain to you is how all those things affect these things over here and how the markets react to it. So let's get over to Rick Santelli. He's at the CME CME Mercantile Exchange. He's going to explain to us how these numbers that just came in will affect the bond market, interest rates, and the equity markets as well. So Rick, take it away for me, buddy.
Rick Santelli here live at CME HQ with the breaking news on this Friday Eve on the trade balance. And do remember, last week's advance.
He said Friday. I had to listen to that twice. When he said Friday Eve, I'm like, huh? And that means Thursday. Duh.
Only included goods. This one includes goods and services. Comes in at minus 61.6 billion. That's about 5 billion less than we were expecting in terms of the deficit. But it does follow a revised 138 billion with a minus sign that was 140 billion. And that, of course, was an all-time record trade balance of goods and services. And as you can see, it has now been cut by more than half. And the big drop in imports seems to be where everyone's pointing. The big news there is how much it bolsters GDP. Just look at Atlanta Fed GDP now, which is at 4.64%. Non-farm productivity comes in much more negative than we were expecting. We were looking for a number that was down somewhat less than 1%. This is minus 1.5%. That would be the worst productivity going all the way back to, going back to the second quarter of 22 when it was minus 3.3%. And here's something interesting. Everybody knows that it's the special sauce of the economy, but consider this. In the 4 quarters preceding COVID, productivity averaged 3.5%. With this current number at minus 1.5, before that, when this is a final read, when it was minus 0.8, the 4-quarter average came in at 1.5%, a full 2% less productivity than we had pre-COVID. That's something to pay attention to. Unit labor cost, 6.6%, a little higher than we were expecting, the highest since the first quarter of 24. On initial jobless claims, up 8,000 from 239,000 to 247,000. We still haven't been over 250 since October of 24, but we are inching up very close to it. That's what comps on this 247,000, by the way. And on continuing claims, we remain this is the second consecutive month over 1.9 million, 1,904,000. So we've had 2 consecutives. We've had 3 readings.